All right. And so, as I understand it, we are looking at setting up some retirement for you and your wife. Um, and I've gone ahead and put together a little presentation and a plan for you, some options so that we can get you set up and ready for retirement. Um, as I understand it, you're both in your early 40s. So we kind of assume you got about 20 years to retirement. Um, and so I've went ahead and put together a little presentation for you here regarding your options. And so first, I just had some statistics just to kind of illustrate the urgency or the need for you to start retiring, which it sounds like you kind of understand. Um, Only 17% of Americans, as of right now, believe they have enough money for retirement. 33% don't have any savings. So you're a little ahead with that $25,000 you have saved up. 48% of Americans start saving at 36 or older. And so you definitely fall into that category. That's not something to be too worried about. You still have time, like I said, about 20 years, but it's definitely something we want to get moving on. 56% of retirees retire before 65. So that would be a nice kind of bonus if we could retire a little early. About half of people retire sooner than they plan. Whether that's a good thing or a bad thing kind of depends. Whether something comes up in the workplace, they can't work any longer, or they choose to retire earlier because they have enough. And about 60% of people spend less money in retirement than they anticipated. And 73% of retirees are not satisfied with what they have saved for retirement. So we really need to make sure we kind of overshoot what you think you might need. You think, oh, maybe I'll need, couple million dollars for 20 years, 65 to 85. Probably need a little more than that just to stay comfortable, stay secure, not be too worried about retirement and having enough funds as you get older. So let's look at some of your options. Really, you need a plan. You could, there's different investment types you can make. You could have a 401k, a Roth IRA, simple IRA, you just be in the market in general. That's something else we could discuss at a later time. What would be tax advantageous towards you as you kind of move into that. Then another way you need to plan is what are you going to invest in? What kind of your returns are you looking at? Compound interest is our friend. This is where the saying time in the market is better than time out of the market. The more time you're invested, the more compound returns, compound interest you're going to earn. Your money can exponentially grow. But you also need to be mindful of risk, especially as you start to get older. If you're 58, market crashes, you don't really want to be fully exposed to that risk. Whereas, early 40s, market crashes when you're 47, you do have some time for that to recover and kind of go and grow back. So you need to be constantly evaluating what your risk level is, especially as you get older. But the return to risk is kind of an inverse relationship. The best returns come with more risk, and so that's kind of a balance you need to play. Maybe now as we're starting out, we start out a little more risky, and then as you get older, you go less risky. And just to kind of give you an overview of what I've identified for you. With just that $25,000, if you allocate it the way that I would recommend, based on the past 3 years of market data, you could end up with about $4 million in about 20 years, based on the last 3 years. So that's kind of what we're looking at, kind of forecasting that out. And so how are we going to make this decision? Again, it's just that risk to reward. Kind of the tools we're going to use that for the reward, we're going to look at the average return. So that's the average percentage return over the past 3 years. Whether 10% return, 15% return, 30% return, that type of thing. And then looking at risk, we're going to use something called standard deviation. It's basically how volatile the investment is. If you got a 20% return, but it's likely to swing 30% either way, you could end up with a minus 10% return or a 40% return, and then you get that average return in the middle. So kind of that balance of, okay, the average return is 40%, but it swings by 60%, that's not really a great investment because you could end up with losing 20%. And the way that we're going to kind of look at that is something called the Sharpe ratio. It's basically a ratio of the average return versus the risk. And so the higher that ratio, the better. So a ratio of 1 would be the average return is equal to the average risk. And so that's, pretty average. We don't want anything lower than 1 because your risk is higher than your reward. You really want a ratio higher than 1 as high as possible. And another thing we look at, something called the beta. It's basically how does an investment react to the market. If the market's up, maybe the investment goes up by a lot more. If the market goes down, the investment goes down a lot more. The investment reacts a lot to the market. Maybe it doesn't react a lot to the market. And that would be a more defensive position. And so those are the kind of tools we're going to be looking at. So over the past 3 years, this is kind of what we're looking at for the market. On the left, we've got the NASDAQ, which is a little more tech heavy. It's got a lot of companies in it. S&P 500 is about the 500 top companies by market cap. These are the 2 most popular indexes that we look at. So we see the NASDAQ, the average 3-year return is a little over 20% versus about 10% for the S&P 500. But we see, the average standard deviation, our measure of risk, 18% for the NASDAQ, so less than the average return, which is a good thing. The S&P 500 has a higher risk level, standard deviation, than return. And so this is where we look at the Sharpe, these red bars. So this NASDAQ has a 1.1 Sharpe ratio, which is good. We're higher than 1. The S&P 500 has a 0.64 Sharpe ratio, which is not ideal. It means that the risk is greater than the reward there over the past 3 years. And so you kind of break this down farther because there's a lot of different companies and investment options, in each of these. You have tech companies, you got finance companies, you got growth, you got big, small companies. So we're going to kind of look at some of the sectors we have to invest in. So these are our different investment sectors. This blue bar is our average Sharpe ratio for the sector. You notice they're all below 7 because there are a lot of underperformers, but we can still look at and kind of identify what sectors are the highest with the Sharpe ratio, because again, we're trying to maximize our return, for the risks that we're taking on. We don't want a high return with a lot of risk. We want a high return or, managing our risk. So technology is awesome. Miscellaneous, short government, long government, large growth. These are kind of the areas that I identified over the past 3 years that have been really good. And then I went and dug a little deeper for you and identified some of the top investment funds to invest in these areas, just because these sectors have performed so well. And so these are the funds that I came up with. I came up with about 3 for the top 5 performing sectors. So these were the sectors we looked at before. And then I identified about the top 3 investment funds to look at. So we look at, like, for example, the commodities. We got these 3 funds, which are all above 1 Sharpe ratio. These brown bars are the Sharpe ratios. A big growth area is the large growth. We got these 3 funds with 1.6, 1.6, 1.6 Sharpe ratios. Very, very high return for the risk. The only kind of low section is a health section, which just kind of helps us be diverse. And all these fund options, I should say, are mutual funds and ETFs. So essentially what that means is each of these, like VHT, for example, is an index fund, ETF, and it's a collection of a lot of different stocks of health companies. And so when you invest in one of these, you're getting a lot of different companies in your portfolio. So you're not like all just based on like one company, which also helps minimize risk. So the more you kind of diversify into funds like this, the more and more companies you have under your portfolio. So technology, kind of miscellaneous sector, large growth, health, and commodity focused. It's a very broad group of companies, but also very diverse, very focused on maximizing your return for risk. And so here's some different allocation options. With those recommended funds that I pulled, you can put all of your money into one company, or you can have an even split where you can maximize the Sharpe ratio. Here in the middle, if you just put an even, X amount of dollars into every fund, you get a 1.3 Sharpe ratio and an average return of 28%, which is pretty awesome. It's pretty good. Significantly higher than what we saw with the S&P 500, for example. If you're looking for like a low beta, kind of minimizing the average beta of the portfolio, which means, if the market has a bad day, portfolio is not going to react as strong versus, it's not going to really follow the market quite as closely. You still have a high Sharpe ratio and a high return. If we maximize our return, if we just invest in only the funds that give us the max return, we'd have a 32% return, but our Sharpe ratio is a little lower, meaning we have a bit more risk. And also when we do that, our allocation pretty much goes 100% into the one mutual fund or ETF that has the highest return. So it's not really a diverse allocation. Here with this max Sharpe, we have a very high Sharpe ratio, 1.4, which means we have very good risk to reward ratio. So we have 1.4 times more return towards our level of risk, which is a very good Sharpe ratio. We're really maximizing our return for the risk we're taking on, and we're still maintaining a 29% return, which is awesome. And so here's kind of a table. We have at least 5% in every fund, and then 35% going into this fund, which has the highest return. So we're keeping things kind of diverse, really maximizing our returns here in this company. So given the $25,000 that you've already saved, and this is not even taking into consideration future contributions that you can make over the next 20 years, I forecast you could have a little over $4 million based on the last 3 years of data in these funds. And so that's pretty awesome. That's if you stay allocated like this, and these last 3 averages maintain. And so, that's kind of an optimistic scenario, given these last 3 years have been very good. But I would recommend revisiting at least every 5 years to reassess, your portfolio growth, your risk tolerance, where you're at, and kind of rebalance the portfolio. We'll probably want to go, less risky as you get older. And so kind of looking forward, time in the market is significantly better than timing the market. And so I know a lot of the concerns nowadays are about coronavirus, market fluctuations, et cetera. Looking long term, it's really not a factor. I mean, we do have vaccines coming up this next year, but I mean, we're looking at a 20-year time frame. And so the next year or so, even the next 5 years, you can't wait to get invested just to kind of, you're kind of scared about the coronavirus. You really want the time in the market. I mean, it's really next to impossible to kind of guess when coronavirus is going to be solved. And so, I mean, there is some uncertainty there. You kind of have to, if you're looking at your portfolio and the coronavirus is kind of dragging it down, you kind of have to step back and think, 20-year time frame kind of a thing. And you still have time to retire. The clock is ticking again. You got to have time in the market, time invested. And so I would recommend, taking action this year as soon as possible to get invested, kind of maximize, where you're at so you can be ready for retirement. And we would be happy to help you do that.